$350 billion of forgivable loans for 8 weeks won't be enough to save 30 million small businesses, Mr. President. Hello, this is Robert Romano, Vice President of Public Policy with Americans for Limited Government, dailytorch.com. Hit that subscribe button. Today we're going to be talking about the recession that we're in now, brought on by the government closures of schools and stay-at-home orders to combat the Chinese coronavirus. This is necessary to encourage people to stay home to save as many lives as possible. The federal government, the White House, has been projecting up to 2 million people could die if we didn't do this. And even with everything closed, as many as 200,000 could die. But that with social distancing, we can limit the damage and get out of this pandemic sooner rather than later and limit the damage. Now, one of the key aspects of President Trump's plan and Congress was the $2.2 trillion package that is an economic rescue plan, really. And what it does is that it will allow 30 million small businesses to shore up their payrolls. And it also includes about $500 billion for critical industries, state and local governments, $50 billion employee retention tax credit for larger employers. But basically, we're focusing today on these small businesses who employ up to 60 million Americans. And the point is, I don't think 8 weeks of support probably won't be enough, and this is based upon the past experience of recessions. Now, along with the expanded unemployment and credit facilities covering critical industries and larger employers, the policy is designed to ensure everyone can stay home, save as many lives as possible. But as President Trump says, the cure cannot be worse than the disease. That's why we have to consider the possibility that $350 billion in 8 weeks won't be enough. Why? Looking back at the past 10 recessions that have occurred since 1948, it took an average of 11 months for all of the job losses to be realized to get to the labor market bottom, and then another 16 months to recover. And the entire ordeal lasts on average about 27 months. So from peak employment, so we'll look at a few of these examples. In December of 1948, 58.7 million people were employed. The labor market bottom came in June 1949 at 57 million. And then the recovery, it took about 12 months to recover. That whole cycle took 18 months. Looking more recently, the Great Recession is by far and away the worst of these examples. From peak employment in November of 2007 to the bottom in December of 2009, we saw 8.3 million jobs lost, and we didn't get them all back until September of 2014. The whole process took almost 7 years. Let that sink in for a minute. It took 7 years, this whole process, from job losses to financial market bottom, to the crashes, to the labor market bottom in 2009, and then another 5 years after that to get to just where you started, basically, back in 2007. And then another 6 years to get to 3.5% unemployment, the lowest in 50 years that President Trump, with his policies, putting America first, cutting taxes and deregulation, and doing these new trade deals, helped the U.S. economy. We were stronger than we've been in such a long time. It's such a shame. But the pandemic is what it is, and we are the damage economically. We have to consider the possibility that it's already been done. Now, in the current recession, the job losses only began 1 month ago with the economic shutdown to fight the virus, and they've already dwarfed the Great Recession with up to 13 million jobs lost. If you take the monthly unemployment numbers plus the weekly unemployment claims, there were 3 million job losses in the monthly report, and then 10 million in the past two unemployment claims reports. And so I say it could be up to 13 million already lost. Likely millions more are on the way. It's just getting warmed up. Now, it's possible that Congress stuck the landing with its package, this $2.2 trillion. It can be leveraged up to $6 trillion, but from the Federal Reserve if the pandemic goes on longer than expected. But I think the idea of a robust recovery, instantaneous recovery, I don't think that's really realistic. It's certainly unlikely to play out the way we're hoping, I think, without certain specific adjustments. President Trump said he'll go back to Congress if necessary, but here's something he can do on the administrative side. At Americans for Limited Government, we've run into a number of small businesses that believe a combination of these payroll protection plan loans and COVID-19 economic injury disaster loans, EIDL, will be necessary in order for, we believe, for all of these businesses to survive. They're going to get 8 weeks of payroll protection. Maybe for a majority of them that'll be sufficient. But we believe that they're going to probably need more support than just 8 weeks because of how long it takes to typically recover in a recession. The shortest cycle you can look at in terms of recovery was in 1980 and then 1982. But it took 27 months to lose all the jobs. But I'm just talking about once you hit the bottom, 7 months recovery, 8 months recovery. Have we hit the bottom yet? Well, on average, again, the job losses take about 11 months. So whatever's starting right now, it could conceivably go on for 11 months. But in 1970, there was a recession where it only took 2 months to get all your job losses. Maybe that's what happens here because of the nature of the pandemic and how Congress responded and basically encouraging people to engage social distancing and stay home. Now, but again, we've already dwarfed the Great Recession, so the idea that we can get out of this really, really quickly and create 13 million jobs overnight, it's ambitious. And with the supports in place, these bridge loans, it becomes more possible than it would have been if we had done nothing. So they do have that, and they have up to $6 trillion to leverage if they need to. But what we're recommending, and many small businesses want to do, is to take out both of these loans. And the difference between the two, if you look at the CARES Act, is EIDL loans and the PPP loans, is that the PPP loans are forgivable and there's no collateral required. The EIDL loans, you have to pay them back over 30 years. There's an interest rate, but you can it can be deferred for up to 12 months. And that's gonna, I think, basically help small businesses to see their way into 2021. I think it is a good target. And it's basically realistic in terms of how the recessions typically unfold, regardless of the cause. There's some thought that, because the government caused this recession, it'll be different. But I mean, if the government murders people, I don't think the cause of death is going to, or the possibility of resurrection is going to be much different. But these businesses believe that applying for a PPP loan may preclude the ability to come back for an EIDL loan when the lockdown is ending, because they say they're not being allowed to include downstream payroll expenses in the EIDL loan amount if they apply for both. And that given the emergency, the collateral requirements specifically for the EIDL loans, which they might need, I think will present a significant barrier to a great number of businesses to qualify, either because of underlying existing debt service or simply because those businesses won't have real estate or any cash reserves to use as collateral. It's probably not a good bet to assume that they have enough cash or assets to offer up as a collateral, especially right now with the emergency the way it is. Now, these barriers can mean a lot of businesses are going to fail, a very high percentage of them, or they're going to be because they're going to probably be unable to qualify for the EIDL loans. What's the likely outcome is they'll come in, they'll do the 8 weeks, but after that they're going to fail. They're going to lay those people off, and so you get all the same job losses anyways. You only postpone them for 8 weeks in that scenario if you don't get the rapid snapback recovery that we're hoping for. That's why you hope for the best, you plan for the worst, and I think that's realistic and rational given the emergency that we're in. Desperate times call for desperate measures. Now, particularly larger entities with more existing debt that was being perfectly serviced right up until the emergency, I think are the ones who will be most unduly impacted by this, because the underwriters can't approve an application because the applicant lacked collateral. The primary reason for this is because revenue is unlikely to return to prior levels for several months during the recession. A fix that could be considered is simply waive the collateral requirements for the EIDL program, just as has been done with the PPP program. For the same reason that businesses only have enough cash on hand to do payroll, benefits, rent, and utilities for a couple of weeks, they similarly are going to lack cash reserves to utilize this collateral for a longer-term loan, even though they probably need a longer-term loan considering what's the economic damage that's already been caused and won't be reversible in the near term. Even if they lift the pandemic right now, these job losses are going to be baked into the cake, and the economic downturn will be baked into the cake. What will determine the duration of that and to shorten the duration of the recovery to get back to where we were will be how aggressively they attack the problem and realize the scope of it. I think when you get all these unemployment claims in over the next few weeks, the extent of the damage is going to be revealed, and we're going to realize that $350 billion is simply not enough. President Trump's already said he'll go back to Congress, but he may think about utilizing what Congress already passed because it can be brought up to $6 trillion if necessary. They should use whatever firepower the Federal Reserve has there to short us up, and I think it can be successful. MBS purchases in 2009 actually tended to stabilize mortgage markets. They took all the bad mortgages off of the banks, balance sheets, prevented the banks from failing, and then this in turn was able to stabilize housing markets. Property values were able to recover eventually once the bottom was realized. But Congress passed a $700 billion TARP due to privately issued mortgage-backed securities, but it was instantly made obsolete when the Fed took over AIG and the mortgage derivative markets and those privately issued MBS. They took those onto their balance sheet, and then they did the Fannie and Freddie mortgage-backed securities, trillions of dollars worth. They brought those off the bank's balance sheets and put them on the Fed. Now what the Fed does on a rolling basis is basically take all the defaulting loans and then kind of recycle them, so they're acting as a bad bank to stabilize housing markets in the wake of the financial crisis. And now it's just kind of standard operating procedure. In this emergency, they've also expanded to commercial mortgage-backed securities, so that in case the small businesses can't pay their rent or mortgages, you're not going to see feedback into these financial markets. They're trying to prevent financial contagion, and they're wise to do so. Just look at what happened last time. It took 7 years for that whole thing to unravel and then to get back to where you started. It was a catastrophe, and it might have been a preventable one if they had realized that what the Fed needed to do was to get in and just to quarantine those mortgage-backed securities. In hindsight, that was the policy that was successful. We were questioning it at the time. We worried about inflation, but in hindsight, the inflation that we worried about was non-existent. The true threat at that time was deflation, as it will be in this recession, which is already bigger in terms of job losses than the last one. And that should be sobering. But it doesn't mean we need to panic. There are programs in place. The Congress had the foresight to pass this package up to $6 trillion. My guess is they'll probably end up using it all, and maybe even going further. They'll do whatever it takes, I think, to ensure that we're not going to lose 60 million jobs from these small businesses. Main Street is going to reopen when this pandemic is over. President Trump will see to it. Now, right now, businesses are looking at the ledger, and they're making determinations about whether these loans are going to help them survive, or if it simply would be more advantageous to lay everyone off. Now, the administration needs to closely monitor those who are qualifying and how many are being rejected and how many entities would actually like both types of loans. The reason they may want to do that is because EIDL gets deferred for a number of months and then they have 30 years to repay. They believe the supports on both the employee side, these businesses, with the PPP loans, and then on the employer side with the EIDL loans will actually help them get to 2021 safely. So they're pretty, it's just a little tweak on the regulatory language. Just by waiving these collateral requirements, you can get these businesses, entities out to 2021, and on average, that's probably long enough to get a V-shaped recovery. So we can plan on a recovery in 2021, and they've already done everything they need to. They just need to act administratively right now, I believe. Either way, the country really needs to help all 30 million of these small business entities, or almost all of them, to apply. They need to apply for this, because if they don't, we're really worried that they're not going to come back. They will go extinct, and it will take a decade to recover from the job losses that we're experiencing right now. Again, the damage is already done. Even if they lift the national lockdown, right now you'll still have all the same problems, and then you might experience a resurgence of the pandemic. So I think that they're going to do one thing and then the next thing, but you're going to work simultaneously, and they can put the plans in place, I think, to shore up the economy so that we're ready to reopen and ready to hit the ground running. So I think that these small businesses, they probably do need the EIDL loans. They probably don't have collateral, and so they should waive the collateral requirements. And I'll leave you with the close here. While it is admirable that the president believes 8 weeks will be enough and the economy will come roaring back, the program has to have a fallback in case the recovery is bumpier than expected. It took 2 years to lose the 8 million jobs in the Great Recession, and then another 5 years to get all those jobs back, and then another 6 to get to the 50-year low of unemployment. If we can't get these businesses to 2021, it could take a decade or more before we get them back. Now, we can hope that the economy comes roaring back this year when the national lockdown ends, as pent-up demand is unleashed. But we have to plan on the high probability that it will not do so immediately. That's the commentary. This is Robert Romano, Vice President of Public Policy with Americans for Limited Government, dailytorch.com. Hit that subscribe button, ring the bell for notifications, and have a good day.